Hello. It is Sunday, August 11th. Going forward, this is going to be a weekly recurring thing where I record a small video on a Sunday. This is a pilot episode, so we'll see how it evolves over time. But it's designed to be a reflection day for my self-documented journey of learning price action. So I'm thinking what I'm going to do today is talk about briefly three things. What happened this week, specifically on NASDAQ. Um, then I'll give you a small walkthrough from daily chart to like an hourly chart, what I thought after the week closed. Then the second big point would be what I did, meaning my approach, what I did right, what were some opportunities that were missed at the time, but I've recognized them as learning points looking back at them, and thus will be using them for growth. And then third is basically a wrap up of what I learned. So takeaways and general conclusions that I can draw from this experience. So without further ado, let's talk about this chart we've got here. So last week, and bear in mind that this is the first week back for me after a long break, like a month-long break. I have not touched any charts. I have not looked at anything. So the intention going into this week was take it slow, um, simplified approach to my model that is still being developed really by me, my mindset and routine. So the general motto was less is more, um, which I find generally fares really well um, if you were to do such a career like trading, where it's the more work you actually put into this, um, doesn't mean the more reward you're going to reap. You sometimes can dig your own hole deeper and deeper and find yourself at a worse space than prior to you hyper focusing on something or maybe ignoring something. For now, let's keep it more technical. So, here's my review. Last week, we've had a large sell off occur going from Thursday into Friday, and we can see that there's a lot of liquidity that was the target for that sell-off, which continued well into Monday. Um, After Monday had closed, I noticed there was a large imbalance, which is basically between the low of Thursday and the high of Monday. That imbalance is a fair value gap, which means that um, there's some fair value that the market had um, left untapped. Or think about it in a way of SIBI, which is the sell side imbalance, buy side inefficiency. Again, I'm not going to go too deep into it, but you might catch on later on as I talk about it. And generally, basically, the general idea is that these inefficiencies, these imbalances, often are the things that the price tends to draw towards. And we can actually see that by Sunday open, which happened about 2 hours ago, price had started going higher, but that's just like on the Monday candle. So we can see actually from Thursday onwards, price had started going higher, wanting to return to the midpoint of this imbalance. And essentially, how I felt in the beginning of the week was that I did anticipate some sort of return into this area before even, for example, before Tuesday had finished trading. I've already jotted this area down thinking this could be a potential medium term draw on liquidity. So in other words, price could likely want to draw there. Um, let's go into a 60-minute time frame. And here's where I actually jotted a couple more ideas down. Throughout the week, actually the clearest idea to me here that jumped in my eyes was how price did this three drive pattern move where essentially, um, let's think about it this way. All of this area here highlighted in green, in the green hourly fair value gap, this is where liquidity providers, in face of the uninformed, generally retail traders, would have felt safe leaving their sell stops behind. So essentially, let's say Jerry had seen this move higher and then this drop lower and then the start of this move higher. If you wanted to get in on it, say like let's say buying it, hoping it would go higher and higher and higher, he was most likely to set his sell stops, that is like um, protective measures, like a risk management measure, where for example if price was to go below the hourly relative equal lows, this little swing low, it would take him out and limit his downside potential. So what I'm trying to say, just think of it this way. This is support that the retail um, portion of the market would think of it as support, and therefore there would be a lot of liquidity residing below that area in form of their sell stops. So that's the lower portion of this fractal of price. But now think of it this way on the upper portion, where we have this three drives pattern. Every time the price goes higher, comes back down, and then goes higher again, and then comes back down, and then finally the third time it goes higher. All it does, it exhausts the individuals who assume short positions by placing their stops above the swing highs highlighted in yellow. So let's say it trades up to here, and then inevitably there will be market actors who would think, or let's say hypothesize price is going to go lower, and then they would sell short as soon as they see this leg lower, putting their sell stops right here, buy stops. That is basically inverse idea of what I just described in the green rectangle below. It's also a protective measure. And every time it goes higher, it knocks those individuals out. And this is precisely basically the sole reason or the sole goal of smart money is to unseat potentially profitable market actors from their seats right in time for the algorithm to start repricing. What do I mean by that? So let's say um, the algorithm repriced up to here. The moment that this price trades above the level of the second um, swing high highlighted in yellow, let's say up to this level, there is a notion that can be described as a stop hunt. Basically, price trades into that area. All those orders that are buy stops, um, buy stop orders for the retail, they get triggered because price traded up to that level. And all those limit orders turn into market orders, and then they flood the market with all these orders to buy. Um, this is precisely where retail is buying, but the smart money is selling, because ultimate draw on liquidity in this specific section of price, like this one, is in fact down here below the half of the range. So this is basically equilibrium right here. if I was to just quickly throw down a fib, this red line is the equilibrium of this range from this low to this high. Equilibrium meaning, think of price always wanting to move between premium and discount. So right now, price is in premium at this little point right here. The retail mind and honestly actions lead to an influx of market orders to buy at market, meaning as in whatever the price is, it's going to buy. So all of this liquidity is flooding the market. And that is precisely when smart money sells, because there's only a seller when there's a buyer, and there's only a buyer when there's a seller. There's no other way around it. It's the market engine. The engine of the market works in such a manner. I might be going too deep into the details, but I hope that you're not losing me here. So here's where order pairing occurs. Smart money is selling. They're selling because they're anticipating price to return to the equilibrium, or specifically discount of this range that I just had the fib on. Okay, so now they sell, smart money sells, price drops, meaning smart money is hugely profitable in that move lower, while all the um, let's say people that, for example, thought that this is a breakout, because that's also another perspective you can view these little relative equal highs at, the first two swing highs. People that thought this is a breakout, they would have bought as soon as price went past this swing high. Those individuals are raked over hot coals because they bought, but then the price goes completely opposite way, just inducing max carnage on those individuals, max loss, max pain, while the smart money is actually gaining all the profit from it. And again, same thing occurs in terms of order pairing when the price finally reaches this green rectangle of an hourly fair value gap, the buy side imbalance, sell side inefficiency, meaning this here was such an impulsive move that there was almost no ability for the market, or I guess market actors, to really sell anything, because this is only one way um, price action. There's only buying going on there. There's only occurring. It's inefficient because usually this is what I love actually, the analogy of painting a wall. If you have a roller and you dip it in paint and you paint the wall, let's say, just generally, if you're trying to do a good job, smooth and consistent paint will be created on the basis of you going over the same spot a couple times. So if you think of it, and if you do the opposite of that and you just dip the roller into the paint and then just swing the paint roller over the wall really aggressively quickly up, it's not going to paint um, distribute the paint very evenly. It would be leaving an area that is highly porous. It has pockets, and those pockets are inefficiencies in the price delivery. So basically, what I'm saying, this area right here, this little gap, you're going to learn how to really see them the more you look at these things. So, and I highlighted this one because I found it very meaningful, especially because this one sat there as this range got generated, and it was below the equilibrium of that range, and the higher time frame context is also important. And it's basically building a narrative, try and understand, trying to read price and see what it actually means. Um, like for example, instead of just thinking, oh, this is all buying and selling pressure, because all of that is nonsense. So this green BISI, buy side imbalance, sell side inefficiency, the second half of that term is basically saying there's not enough sell side delivery in that area. That is solved the moment that price gets traded down into here. That area becomes efficient for that point when the price trades down. It offers sell side in this sell side inefficiency. On top of that, all of these swing lows, you see how they were also, so this is the lowest swing low. Then this is the second lowest swing low. And then there's a third lowest swing low. If you think of it before, let's say before this occurred, like if you just didn't see this, let's say we were a little earlier into the time horizon. So like let's say if we were looking at price at, I don't know, 5 a.m. on Wednesday. That alone would, again, tickle the retailer's mind in a manner saying, this is a sigh of relief. That area is safe. Or so they would want the retail to think. That is precisely the reason the retail mind would go there and set their sell stops there, because they would feel safe. All it does is sets up this perfect breeding area for a shark frenzy to later occur when smart money gets down, when the algorithm reprices the price of the instrument into that area. And this is where smart money gets out of their profitable short positions that they've taken on at the top here, because it's always been sell. For example, it's always been sell short at the highest point for smart money and buy at the lowest, because smart money do not ever want to buy in premium and do not ever want to sell in discount, because price only moves from premium to discount and discount to premium. And it's a balancing act. But I really went off on this one. So I hope it's giving you some sort of insight into the mechanics so far. Um, so again, I was taking this week easy, so I wasn't actually reading any of this price action in the moment. The first day that I've actually started looking at price was really Wednesday PM session, when in fact this move lower was occurring. And again, I wasn't able to sit down from like 1 p.m. to 3 p.m. or anything like that. I just had a glance for 15 minutes at like 1:30 p.m. New York time. Um, and actually, I want to share this. So now, taking into context what I was saying about price likely moving lower after that three drives pattern had occurred. Um, Same thing on the lower time frame of 15 minutes. So 15 minutes, for example, each candlestick like this is 15 minutes worth of price data. This space right here forms a relief-like impression, again, a false sense of security that price had respected this level of support before. Therefore, many market actors will confidently have their sell stops left here if they had bought in on the rally higher from here onwards. And this pocket of liquidity is what smart money relies on to pair their orders to cover their short positions that they had assumed from this area. Um, Again, yeah, I'm just basically going over the same idea of third consecutive drive higher, after which price broke down. You don't even need to sell on here. All you need to know is that um, markets function in the context of two dimensions. First is time, always, and then it is price. Because our charts are written in two, like they're 2D. So you can see that on the lower axis we have time, and then on the right axis we have price. And understanding that simple, really, I guess, axiom, you understand that price is likely to move during specific times of the day two specific points of interest. Now, let me paraphrase this. So basically, if you build around a context of what the price has been doing and has done so far, and you have an idea where it's likely to go next, that idea really flourishes when you apply the time to it. So, because it narrows down your recipe and the likelihood of it panning out, if it makes sense. So, let's say New York PM session starts around 1 p.m., usually 30 minutes after 1 p.m., so 1:30 p.m. is a good time. So, for example, on Wednesday, let me see. Let's go to Wednesday. That's Thursday. Wednesday at 1:30. What we have here? This is a larger leg. You can basically see. In fact, I'll probably do this. So, right. So what we've got here is the chart that I had earlier. And this spot right here is where this is occurring. This is the start of the PM session, 1 p.m. right here. And this is 1 p.m. hourly candle. What we have here, we know at this point, just just step into my shoes and use some of my experience so far. Let's say we knew exactly that price was actually drawing towards this imbalance, to fill it and to let the smart money pair their short orders and basically cover their positions. So then what do we do next? We assume the draw on liquidity is lower, and we aim for the lowest hanging fruit, because that's how you become consistent. You just go for the lowest hanging fruit objectives. That's how you build consistency. At 134, let's say at 130 we start looking at our um, landscape, and we see these relative equal highs. Well, really, the swing high gets ran again. Think of the same thing I've explained on the hourly chart. This is where the order pairing occurs. This looked like resistance. Resistance broken turns support. People buy on here, but then they get raked over the coals by the smart money that is actually selling here. Once the price displaces lower below a short-term low and forms a bearish market structure shift, and then leaves a fair value gap, this is a SIBI, so sell side imbalance, buy side inefficiency, they tend to be retraded to before price continues lower. This is basically the model. So you sell right on here or wherever you want, and then you hold for the lowest hanging fruit objective, which is the swing low, and this is 50 points. Anyhow, this is just one example, and this is how journaling basically is done. You are, all you're doing is you record your thoughts on the moves that you've either read live, as they were happening, but that takes a lot of experience, and you record your thoughts in a positive manner, always encouraging, because that's what builds your pseudo experience to then build your trust to the point that it's enough for you to trust those things as they're forming live. And of course, eventually you start taking action on them. So I'm not gonna go over Thursday because I think there's gonna be a lengthy video, but I will go over Friday because that's when I actually took a chance, like attempted to do a trade. And on Friday, I didn't have any higher time frame bias, and bias meaning an expectation where price is gonna go long term. Besides that, I thought that it's likely to go to the daily imbalance consequent encroachment. Let me quickly show it to you. So consequent encroachment of an imbalance is basically the midpoint, which is highlighted here with the dashed line. So that was basically the only precursor um, on a higher time frame um, as to where price is likely to go. But I was keeping it simple and relied on the idea um, that I should just be looking at lower time frame on 1 minute, let's say, and search for the most prominent smooth areas. Because again, the smooth areas are where the retail mind will think this is safe because price has left this area, well, like very smooth. Like this is textbook. This is absolutely textbook. What everyone is taught in the market is that if you have a line, like a trend line resistance level, then you should leave your buy stops above it. It's just, it's written everywhere and it's like basically everyone does it. But that is not the way that smart money works. So here, let me just quickly walk through my ideas from Friday. 7 a.m. starts off the day at New York time. What we do at 7 a.m., as soon as 7 a.m. closes, like the candle for 7 a.m. closes, we start looking for relative equal highs. Here's one. Then price trades away from it, even further um, building, engineering buy side liquidity by means of sell side delivery. Okay, that was a mouthful, but essentially, when price leaves this area, we have this resistance. It looks very smooth, very inviting, very safe. When price impulsively moves away from it, that even further builds off the idea this must be right. This, in fact, will not be traded to, and I can leave my stops there. Basically, that's the gist. You keep looking and hunting for these smooth areas every time the new hour starts. So at 8 a.m., we look for, again, relative equal lows, relative equal highs. We see that at 8 a.m., there's relative equal lows right here. And then we have some sort of resemblance of relative equal highs right here. When we have both like both sides of the market present, we don't do anything. We sit tight and we wait for more information by means of what market will do next. So let's say if market runs out the relative equal lows first, then we know that the likelihood that it's going to be running out relative equal highs after that is higher. What proceeds to happen is market just keeps trading lower and lower and lower and lower until it reaches the bottom of that daily imbalance. But for now, just ignore that idea. Just think of how we've been just trading and lower and lower and lower. Then price starts consolidating, and at 9 a.m. we have relative equal highs, and we had already had a feeding frenzy, what I call a stop hunt, occur right here. Essentially since 8 a.m. because that price kept running into these relative equal lows non-stop. And if we actually look slightly to the left, we will see there's really nice 15-minute relative equal lows right there, which price ended up running out. bottom of the daily inefficiency supports price from falling lower. And notice how it sweeps the relative equal lows and then switches to engage higher price, returning into the middle of the range. And range is this range that I'm talking about. Middle of the range, and then towards the consequent encroachment of the daily imbalance, as in this is the consequent encroachment of the daily imbalance, this dashed line, as I said earlier. Okay, so next. Oh, I hate when it does that. Okay. What now? We have price run out all of this liquidity on the lower side. And after 9 a.m., we see consolidates and then it starts going higher. Here my thinking was this SIBI, basically every premium discount array, which is essentially every inefficiency has an inverse of that inefficiency. And I was monitoring how price would react to and navigate that sell side imbalance, buy side inefficiency. And I was seeing if it will first respect it and then trade through it, because that's precisely what it did. And that qualifies often. Not only just that, but you need that on top of other things like higher time frame bias, narrative, and context of price, which are more crucial often than what I just told you about. Oh, if it gets like a retest, then goes lower and then breaks through it, and then the next retest is when you would anticipate it to actually support price and act as an inversion fair value gap. Essentially, as soon as I saw price like just pierce through it, at that point I felt quite confident that it is likely to continue trading higher, and if it was to return back lower, I would anticipate that inversion fair value gap, this rectangle, to hold price. And as you see, as we trade higher, this is actually our New York open. So that's the opening bell. Equities open at 9:30 a.m. every Monday to Friday. Um, this is when volatility rushes the market, meaning orders are coming in super fast, and this is when quick, sudden movements occur in the price. What happens? It blasts through that inversion fair value, well, essentially this gap. Then it returns and taps the consequent encroachment midpoint of that gap and trades higher, and then the next candle closes green. This is when I took it as a strong up and away reaction from the inversion fair value gap consequent encroachment. The very next candle closed objectively higher, that's the green one I was talking about, and this is when I dropped into the 15-second chart to hunt for an entry. Um, let's in fact go back to 1 minute and then I'll just cut it at that area because it would be a pain trying to navigate every time, scrolling all the way to the right. So 15 seconds, what we see here is nothing short of a beauty, to be honest. But this is where it gets interesting. This is where I identified my learning opportunity. So this is 15-second chart of the same price action that was happening on 1 minute chart. It's just more detailed. It's the same fractal of price, but often 15-second, like often going lower into the time frames, you will see additional detail that you probably may not identify on higher time frames. So as soon as the tap into the consequent encroachment occurred, this move right here is truly algorithmic because what follows is a strong displacement higher. Like displacement, think of it this way. You have a kids pool, like a blow up pool that you put in the backyard and you fill it with like some water. If you have that little pool and if you throw like an elephant into it, like, or if an elephant just decides to plop down into that pool, all of the water that was in there will displace out. There will be no water. It'll be just an elephant sitting in that little blow up tub. That's precisely what happens, is because when this occurs, what happens in the background is the algorithm that delivers price is basically, it gets so much volume into it that this the price engine essentially starts spooling like a ribbon. It just goes off. When that occurs, that's like a signature for smart money to know, hey, there's a reprisal going on. As soon as the price goes above a short-term high, swing high, this one, and creates a market structure shift. This is a bullish market structure shift, which left behind this large blue inefficiency, right? What we are taught and what a lot of people's models are alongside with my preference as well. I like that model. We take it as this inefficiency is an optimal, I mean, there's many other ways, but let's say this inefficiency, this blue gap, is an optimal spot to enter and hold for a long, specifically for this target, which is the relatively equal highs. In fact, this is completely equal. Like they are literally at the same point. Um, Equal high. So it taps it, and this was a demo trade. So in demo, there's no spread. Even though this was the same price essentially, as soon as the price tapped this same level, it in fact still tagged me in. But it is unlikely to happen if you're trading real money, so you need to account for spread as well, of course. But this is quite rare, so it happens. So what did I proceed to do when I was at that time trading on a Friday at 9:39 a.m. and 15 seconds? I, I, being perfection driven, I in fact focused on aiming for 51 points because I thought I want to get a really nice 2 risk to reward ratio, meaning that if I risk 25 handles, I want to make 50 handles. But moreover, I add on one more handle because I think it's going to pay for my costs and commissions. Of course, what proceeds to happen, price wicks this equal high level. Probably a lot of smart money offloads right there, and then like a short-term retracement or even slight reversal occurs. And luckily, what I did was in fact just move my stop loss by this time to break even, and I protect the rest of my capital. But the real takeaway is, and here's the juice of this whole video, I guess, and I'm probably gonna say this and wrap it up. There's no such need to demand the market to give me nice and round numbers for my profit. Me framing this on a Friday and executing this trade idea, I forced the market to give me more than was reasonably expected, really, and it led to my trade falling short and me being taken out. I am, however, very happy that I managed my risk in the way that I did by moving my stop loss to break even when price was past the 75% um, of the anticipated price range. Really, price basically it was literally right here. And then it started moving lower. At that point, I was like, I'm bailing. I'm out. I'm not holding that. This was a mistake. I'm glad I recognized it in the moment, but there's still learning to take away from it. And this learning, which is relatively, it existed in me for a while, so I just need to unpack it and go through it, is that I need to let go of perfection. There's no such thing as being right or wrong and control in the market. As soon as you put on an order, I've made it my I'm trying to build a habit of that. As soon as I make a trade and go into it, I should say to myself that I invite myself to be incorrect about what my assumptions about price action are right now and when I go into a trade. Essentially, what I'm saying, as soon as I press the button, I'm asking for like a lion to tear off my face because you gotta invite that. You gotta be okay with that. And that's when I say you got to give away your control. Like as soon as you press the button, just let the market do what it does. Certainly, um, move slow to make money and move fast to save money. That's actually a saying I really like from one of the traders that I've kind of followed on the side. Anyhow, um, I'm certain I will acquire new levels of confidence and skill as I unlearn the need for perfection on my exits and bottom line. This behavior is truly toxic and it only holds me back. Instead, taking aim at lowest hanging fruit objectives, this literal green line that I've outlined, if I just put my sell limit there, I would have been golden. I would have been very happy. Um, but again, there's no point crying over spilled milk, right? Um, and in turn, when I aim for such low hanging fruit objectives, it will let me relax. And when I let go of my need for control of the market, in turn, it will grow my mindset and train my mindset that these setups are simple, logical, and they follow a rule-based idea, and they're consistently unidentifiable. Like you can find one setup a week, and that can be your model. That's all you really ever need. That blows my mind too, by the way. Additionally, such approach will ease my progress of learned desensitization. Basically, the more you do it, the more you learn to let go of control, the more you learn to invite uncertainty, and the more you follow a rule based idea, you will not experience fear of being wrong. You will not experience those troubles and attachment to needing to be right. And moreover, like furthermore, attaching even money value to that. That's just even more weight that you shouldn't bury on you, like you shouldn't bear on yourself. And actually, I actually just forgot about it, but I good thing I wrote down notes before this. I recall Thursday when I actually attempted executing a trade as well. Um, I actually had vivid jitters and I didn't even press a button. I was in anticipation of pressing a button for for a trade idea that I had. And simply in anticipation of pressing a button, I literally had vivid jitters, like body sensations, like heart palpitations. But I would not go as far as to call it panic because I was yet to press a button, so there was not like a deed that I have already done. And it is a reasonable assumption to link that behavior that I described I felt on a Thursday with my fear of being wrong and or my need of being right. Um, you know what? F it. Let's go through quickly the Thursday because it was an interesting day. I mean, it was really cool. Thursday, look at Thursday. So you can actually see Thursday this week literally brought us all the way from this sell-off that we've gone into all the way back into the daily imbalance. And remember what I said, that is usually how the inefficiencies work. They invite the price to return to eradicate and make those inefficiency pockets efficient again. You follow? Um, so Thursday. Shortly after Nasdaq priced back in below into the equilibrium of laid out in the first half of the week, so Monday to Wednesday. Following a rebalancing of the hourly BISI, this one, and a sweep of relative equal lows, this one, which basically upset all long-oriented traders, meaning traders that were hoping to go long and hold on to price, they would have had their sell stops here, meaning they got taken out. Price was now free to reprice higher. Again, why? The reason for why we think it would reprice higher, this is basically how you build narrative. What happened? There was a stop hunt. What happened? Price traded from premium to discount. What happened after that? It started, well, we basically did all those two things. Um, I'm losing my words here. It's getting a long video. So we had an idea, and as we see these things fall into the pieces of the puzzle, we knew there's a daily inefficiency above us, above the market price. This is this red fair value gap. It only further built on that idea that, yeah, maybe it is likely that price will actually seek premium and seek buy side liquidity, meaning go above those uh, uh, the swing high and return into that inefficiency and make it efficient. Um, we don't need to hold from this spot all the way to, for example, where price reaches that inefficiency, or all the way to this high, or all the way to the consequent encroachment. That may be terminus as in the end of the price leg. We need lowest hanging fruit objectives, and one of such objectives was the halfway, again, the equilibrium between this range and that range. And it's found um, inside of that area, like basically slightly above the equilibrium of that range, we have an inefficiency. It's a 15-minute sell side imbalance, buy side inefficiency, meaning that there's only sell side offered in this time. There's no buy side, and therefore to make that area efficient again, price needs to trade into it and offer the market buy side delivery. That's what we're aiming for. And also there's a swing high right here, meaning actually I never even explained what a swing high is. Swing high is a 3 candle formation where left candle is lower than the middle candle, and then the middle candle is higher than the right candle. So basically like a like a 3 point um, peak. Really, that's what it is. Above those, we always assume the algorithm doesn't even need to know how much liquidity there is. It just knows that above swing highs, there is liquidity, and below swing lows, there's also liquidity. Excuse me. Um, so, with that, let's jump into 5 minutes. And let's jump into this fractal of price, and let me open the notes for, oh, they should be open. August 8th. Yeah, right, okay. So August 8th was in fact a news day. So we had news coming out at 8:30, and it was unemployment claims, which also just basically implies that there's going to be volatility and there's going to be moves going on in the market that often will actually help um, reading price. But also there's going to be a lot more alleviate like increased risk with that too. So this is what happened. Again, 7 a.m. is right here. I wasn't at the charts then. I was at the charts probably at 8:30, like slightly after the news release. News released, we have this huge imbalance right here, this inefficiency. And by 9 a.m., what do? We look at what the market has created by then. We see that there's relative equal highs here and equal lows. What do when we know that there's both of the sides of the market that are quiet? Um, we don't like, let's say we're not sure which one is going to be taken first, so we don't gamble. We wait for more info, and we see what gets taken first. What proceeds to occur at 9:30 opening bell, 9:30 a.m. equities open, price goes lower, and it takes out the equal lows. That's where the order pairing occurs. That's where the retail has to sell and the smart money buys. That's where the smart money gets in. That's where the retail lets the smart money get in because they sell, because they are protecting their stock, they're protecting their positions because they thought it's going to go higher. Again, the whole paradigm is that smart money works in a way where it uses the knowledge around the algorithm and the engine of the price delivery to unseat potentially profitable actors in the marketplace and assume their positions and reap the benefits of that. And I mean, yeah, that's basically it. So perfect. This is amazing delivery. It's you see how price trades lower, takes out the equal lows, taps that little inefficiency, and what proceeds to go on next is, let me just expand it a little this way. Well, I even wrote down the daily fair value gap right there. That's really nice. So we tap it. I mean, the price taps it, and then boom, it goes off. It just starts algorithmically displacement, algorithmic displacement. This is very, very clean. However, when I was reading price, this is when I had the palpitations over even deciding to press a button. I saw this imbalance and I anticipated price to return into it, but it was just going off for races. And I'm not sure if I even saw this imbalance. I may have been too in my emotion of the vivid jitters that I was like experiencing. I was like, I've got the idea that it's going to go higher. I've had the target set, the daily inefficiency, the you could even go for the lowest hanging fruit as we should. But yeah, I just missed it, and that's fine. It's part of the game where you have to be okay with missing a trade, and you cannot let that completely destroy you mentally. Again, this is probably a really good training because had I not experienced vivid physical sensations, I would probably be more focused and in the zone to even notice another gap because this gap is completely fine for an entry. And here we can see this displacement leg. As soon as this candle closes, the candle at 9:55, so this candle starts trading, we have an imbalance here, the light blue or cyan color, and by then we have the market structure shift to the bullish side above a short-term high, a swing low. You can enter here. That day I actually didn't drop into like lower time frame. I just read the price and I was reading the price all the way until probably reached to, let's say, 8:30, 8:50. Well, I mean, sorry, 10:30, 10:40. Yeah, 10:37. Yeah, and your model might not be what I'm doing at all. It doesn't have to at all because you might be someone who would be very confident in knowing that price ought to go to the daily bearish fair value gap and maybe buy on this green imbalance because, for example, a previous level of buy side liquidity broken, that's what acts as true resistance turns support. If you extend that to the right, you can see that it's the same level, and that's like a premium discount array in of itself. Anyway, I'm rambling. Hopefully this video was not too hectic or chaotic. I'm gonna go through some evolution of these videos, probably make them shorter, maybe make them longer, I don't know. Um, I think this has been a really amazing experience so far. And actually, before I close this off, next week, um, next week being the week of Monday, 12th August, I will start streaming once a week at least. And that stream will probably come on a Friday, and that would be 6 a.m. Mountain Standard Time. So essentially, I'll be going through all of the live price action on the stream, and I reckon that the weekly reflections they're going to be a little shorter going forward because I will not actually be talking specifics in the weekly review because essentially if you watch my streams you would probably get the gist of the price action. I'll just do a quick overview, like maybe daily and hourly, and that's all. And maybe like show a couple screenshots of the actual lower time frame um, trades or trade ideas or trade potentials. Anyway, thank you so much for staying with me, and yeah, I hope you got something from this.